Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I am Billy and joined by my co-host,
Andrew. Back again, Bills. Back again. Another podcast, another day, same intro.
Another day, another podcast. That's it, my man. That's it. Andrew, how have you been?
Yeah, all is well, Bills. All is well. A little bit of an insight into my personal life. But yeah, my wife is due to give birth in the next week and a half with our first little one. So bit of excitement going on there.
So depending on when we decide to broadcast this podcast, it may have already happened.
Yeah, probably will have. It actually definitely will have.
So there you go. Congratulations to Andrew on the birth of the newborn.
Yeah, exactly. Congratulations to Andrew that didn't do very much. It was definitely Stacey that did all of the hard work.
Stacey, well done. If you ever get a chance to listen to this, we're really proud of you.
Nah, she doesn't listen to me. She hears me all the time. She's sick of me.
Well, she hears you all the time, or she doesn't hear you all the time, right? Yeah, exactly.
Selectively.
That's it. But for our listeners, we are recording enough podcasts, so there won't be a gap in our schedule. So you'll get to hear from us each and every week while Andrew is off in the early stages of the little one's life.
So we've planned ahead.
Yeah, exactly right. And funny enough, Andrew, fantastic conduit. And that was not planned, by the way. I wish it was. We're not that clever. But Andrew, take us into what we're talking about today and talking about planning ahead.
In terms of planning ahead, we're talking all about being asset rich but cash poor. Probably heard the saying before, that's quite common. But yeah, today's episode is all about exploring the asset rich and cash poor.
This is something that we see as financial planners, and unfortunately it's all too common, and there are solutions and we'll get into it and stuff like that, but kind of trying to tie it back to the conduit is if you don't plan ahead, you can quite easily fall into this position, and it happens. We've been really fortunate that property in particular, call it the family home, property prices have done really well. So we're finding that in a large amount of clients that are in this position we do talk to, they necessarily didn't plan ahead, have assets, but don't necessarily have the income, or the income's not being derived from those assets to provide the level of income required to live the lifestyle that you want.
Yeah, I think perfect example is someone that's purchased a property in Victoria and lived in that property for basically the last X 20, 30, 40 years. You're asset rich because you've got property that in many instances is worth way more than you ever would be able to afford today. But in terms of cash flow, in terms of money coming in, essentially in that scenario, there's nothing. So you don't actually have any money coming in from that asset. But yeah, anyone that's purchased properties in the 60s, 70s, 80s and held on to that for a long period of time is fortunate in one instance, because obviously you've had the benefit of asset prices increasing, but in the sense of cash flow, in the sense of really retirement, you're needing to make adjustments to your position at the end in order to be able to facilitate a required income level in retirement.
Yeah, well said. Absolutely. See it all too common. I mean, look, this really happens as a result of, I guess, particular types of assets. We've already touched on it. Residential property is probably the big one.
And even investment properties to some degree. I mean, they will provide a rental income, but most rental yields, depending on the property, depending what we're talking about, you're looking at 2 to 3% in terms of rental yields if you're lucky. You can sit the income that you can generate off an asset in so many other environments that's much larger than 2 to 3%. So even investment properties outside of just the family home, you can also find yourself in this position as well.
Yeah, and in this example, and I guess my parents were probably an example of this, a lot of the older Europeans as well, is you bought a property and your objective was to pay it off. And that was really as far as kind of your investments and your wealth creation. And then it was, okay, the owner-occupier, that was probably the first thing, the family home. And then it rolled into another property. Maybe you were lucky enough to buy something down at the beach or a holiday home or something like that. And it kind of went like that. So it was get a property, pay it off, and then essentially just rinse and repeat. And even if you're talking about investment properties, you're talking about a property, use $1 million, maybe you're getting $20,000, $25,000 a year in rent. By the time you back out expenses and management costs, land tax, you're probably talking a fairly small yield of a couple of percent. I know we're generalizing here, But once again, having $1 million asset that's only providing a 2% yield or a 2% rate of income return may not be enough to meet your income requirements. And once again, this comes back to having your asset rich, but your income poor.
Yeah, exactly. And look, don't get me wrong, it's a good problem to have because at least you've got the asset, much better than not having the asset at all. And not to jump to the solution at the end of it, but planning ahead is ultimately the key in this and in anything that we do in financial planning and wealth creation is plan ahead, because it's very easy to fall into this trap. And you consider that scenario that Billy's talking about. You've got a holiday home or you've got an investment that's not generating sufficient income in retirement. Well, what do you need to do? You're kind of forced in a position where either you have to live well beneath your means, so drastically reduce your expenditure.
Or whatever your means are at that stage, yeah.
Yeah. Or you sell the asset, and the costs of selling, the costs of employing a real estate agent, the cost of capital gains, all of that stuff comes into it, where otherwise you may not have needed to do something like that if you had planned ahead and if you had positioned your assets in a way where you knew that it was going to provide you sufficient income in retirement.
Yeah, and it's always conflicting, and I want to do a bit of a deeper dive on that because we have that conversation all of the time, but sort of bring it back to the basics. When I talk to people, and everybody's approach and thought process and attitude is different with this, but I think first and foremost in my mind when I'm talking to people about this, you're building assets throughout your wealth accumulation years, not just for the sake of building assets, but it should be to provide for yourself at some point in the future. Plain and simple. And whatever that looks like, it's different for every type of person. If you're asset rich and cash poor, you still have the ability to do that just by changing some things around. Andrew, you mentioned it a little bit before, but I tend to find that when I'm having these conversations, especially around property, there seems to be a really large resistance around doing those couple of things. There's selling the property like you had mentioned. There's other financial products out there like reverse mortgages as well too. There's downsizing and trying to release some equity, moving from a larger property, buying a smaller property and using the difference to invest to derive some form of income. I find that, and it's probably because of our whole attitude and approach to property, I think in Australia, there's a lot of resistance around doing that. And for me, thinking about it from a financial planning perspective, we're trying to get people to grow their wealth to provide an income for themselves at some point in the future. So it goes kind of against what we talk to clients about all the time, which really comes back to, I guess, what we said right at the start. If you plan early, I think you can have your cake and eat it too.
Yeah. What do you think it is? I mean, why do you think people are so resistant to selling property, to liquidating property, to doing all of those things? I mean, what have you found in your experience, Bills?
There's probably two things I think from my perspective, if I really think about it. The first thing is just knowing how difficult it is to get a property. That's the first and foremost. Actually, there's probably three things. The emotional attachment connected with that particular property. I bought that back in the day. I worked so hard for it. I paid it off, did all of that stuff. And then depending on who you're talking to and what they want the future to look like, and being a parent, I understand this and I get it. And I'm in that position too, is at the end of the day, if I can leave my children with something to help them out and try and help them get a leg up or not be under as much financial pressure as I was or my parents were and kind of pay it forward, I think it's probably one of those three things or a combination of all of those three things working together where that approach and that attitude comes from.
And look, you can understand the emotional connection. You can understand that when we talk to clients, and especially when I'm talking to clients, the one thing that I'll always put as a disclaimer is I don't want to downplay, but it's quite easy and simple to look at things objectively and to look at what is the best financial decision that a client can make. And sometimes that intersects with what they want to do emotionally, but sometimes it doesn't. And I think the property is really one of those asset classes that pulls on the emotional heartstrings. And for some people, even though they understand that it's going to have financial implications by doing X, Y, Z, they have a certain affinity or a certain emotional connection to an asset and they don't want to liquidate it. So even though you might have all good intentions from a financial perspective, sometimes that's not the right thing to do, because if emotionally you feel like doing something else or you're not comfortable with something or hits a certain heartstring, then that's perfectly fine. But if you can plan ahead for it and if you can avoid ever being in that position in the first place, that's ultimately going to lead to a better outcome at the end of the day.
Yeah, there's probably two other things with the three, but not as prevalent when I'm talking to people. The first thing is, depending on what asset it is, and I'm primarily talking about the family home, is the Centrelink implications. So as the law currently stands at the moment, your house is exempt from any Centrelink calculation. If you were to sell your house, downsize, release equity, and deploy that money in an investment, and we're talking about being over thresholds and things like that, but it may impact your Centrelink entitlement. And a lot of people can feel quite passionate about that. I've worked my whole life. I've paid my fair share of taxes. I should be entitled to something that the government's going to give me. Depending on your financial position, I think that can be a bit of a fallacy, because that direction then says, okay, my income is going to be capped at whatever Centrelink is, and my lifestyle will be bound and determined by that. And I get it and I understand that, as opposed to, hey, if we did that and you forfeit a little bit of your pension, but it may mean that you can generate more income overall and have a greater lifestyle. I think that makes more sense mathematically, but I definitely understand the other way. That's definitely the first thing that I think out of that. Not as prevalent, but that also comes up as well. And the second thing, you alluded to it before, is, okay, I take this money out of, we'll call it property, and I've gone and now released or come up with a lump sum amount. It usually be a significant amount, whether you're selling a property or whether you're downsizing. But then it's the fear about, hey, what do I do with it? Like, I've been invested in property my entire life. All of a sudden, I need to go, and the thinking tends to go towards, I've got to buy shares. I've got $1 million. I've got to go buy shares. I've never done it before. I see this stuff on the news. I understand property. It never goes down. Shares go up and down. I see this stuff on the news, in the newspaper. Share markets crashed, all of this sort of stuff. So there is fear around that. And needing to make that decision at a point in your life when you don't have the employment income to top back up if the markets do go down or what have you, can leave people almost financially paralyzed, where they can't make a decision, and the most comfortable and the position that they stay in and the decision that they make is to maintain the status quo. So it's, hey, I understand that I'm getting this level of income. I know that you're telling me that my life could get better if I improve my income. I understand the steps that you're telling me and what needs to happen in order to make that happen, but I just don't feel comfortable enough. It doesn't pass my sleep test. And you know what? I'm not going to do it, and I'm just going to live like this, and I'm going to adjust my lifestyle and accept it.
Yeah. And throw back to literally one episode before this, where we're talking about starting your investment journey early. It's that scenario, what you're talking about, and that picture around the fear of the unknown can easily be avoided. And I cannot stress the amount of times that I've seen this. It's so common amongst so many people in that generation, because property was the thing. Property was the thing that did well, and it really has performed as an asset class. And it was, for that generation, something that ultimately was all that they looked at from an investment perspective, maybe because it was there, it was tangible, you could see it, and you didn't have the same access to investments like you do today, where investment markets are kind of a bit more in our face. I think for the younger generation kind of understands the ability to invest in things like shares, things like managed funds, things like crypto, while the technologies come up and it's available and it's easy for the everyday investor to get into it. You can have that comfort level around it, or you've been exposed to it for a long enough period of time. But it can be a really difficult decision to make. So you plan ahead, you know what you're doing, you've got a strategy in place from the beginning, and you're not having to do it in one huge lump sum with a whole heap of tax and costs associated with it as well, is certainly the position that you want to be in.
Yeah, around the property conversation, I was thinking about that when you were talking through that, Andrew. Thinking about, I guess, my family's experience, migrated to Australia, quite a common story in Australia. They made the decision to come here for a better life because life was not secure where they were. And latching onto property was the one thing. I've got my patch of grass, I've got my dirt, no one can take it off me. It's tangible, it's real, it's mine. So that was very much the mentality, and understanding all of this other financial investment options probably wasn't in their purview, and they didn't need to go down that path. So I really get that. And probably the other thing, and I'm not going to say it's going to be easier because none of this stuff is easy, but with the introduction of compulsory superannuation from 1992 onwards, this having retirement income, and going back to our conversation in the previous podcast about compounding interest, if you're in the superannuation system for the majority of your working life, this problem gets alleviated almost in its entirety. Be careful how you interpret that, but if you're receiving super guarantee contributions for most of your working life, you should have a fairly healthy balance at the end of it, which will provide your retirement income down the track anyway. So hopefully with that system, and it continues on, and obviously we've got record low unemployment rates in Australia, at the end of our working careers, hopefully this isn't a problem that we're going to see as prevalent as what it is for us as financial planners today.
Yeah. Nah, perfect. Really like that because it's ultimately true. And whether people recognize it or not, most of the time your superannuation is invested in these liquid assets. And so the exposure that people have to it is significantly more than what it was perhaps in the past. But there's probably a couple of other assets as well that can be in or fall into this bucket in terms of being asset rich, but yet still cash flow poor. We've already touched on residential property. That's a large one. We've also touched on, obviously, the principal place of residence, so the property that you're living in, that you're obviously not generating any income from. Land ownership, that's another relatively common one, maybe not as common as property and residential property, but holding large blocks of land, whether that's farmland, whether that's out in the country, which is where most of the land ownership is held. That's another asset that also delivers very little, if anything, in terms of income from that asset, but can still be worth a significant amount more, or a fairly significant amount in terms of asset value, but also shares in a company. So whether it's a private company, even some publicly listed companies that aren't paying dividends, ownership in certain companies can also fall into that category in terms of assets that are worth a hell of a lot, but from an income perspective aren't deriving the same level of income as what you otherwise could be doing and otherwise could be enjoying the fruits of your labor. So really touched on a few things in terms of the type of assets that fall into this category or can fall into this category. Once you're in this position, you're forced in a position where you either obviously reduce your expenditure, reduce your asset base and move one asset from one type of asset to a different type of asset. The tax implications of that, downsizing family homes, really touched on reverse mortgages a little bit. But what do you do? How do you not get into this position, Bills? How do you make sure? We've already given you the answer at the end of it, but
just to tie a bow around it, to summarize it nicely.
Really nice bow around it. What do you do? How do you not get into this position?
Well, I think there's really two key messages here. The first one is to plan ahead. And it's pretty simple to say that, a lot harder to actually do it. And obviously, we're in the industry, we're in the profession, so we always advocate to receive financial advice. So if you go and talk to a financial planner, this is the conversation that they will have with you. They should bring this up. You will be in a position where you're starting to think about these things, probably in a little bit of a different context, and being presented with things that you probably never even considered or thought of. But once again, take that step, plan ahead, start thinking about it, and engage with a professional to be able to help you along this journey. And we've both been through the financial planning journey before. It gives you the level of confidence and clarity in terms of where you're going and what you're doing, just to give you the peace of mind that you know that you're making the right decisions to benefit your future self tomorrow. And I think that's a really powerful thing that you can do for people and do for yourself as well too, is just having that peace of mind, knowing at the end of the day, and I actually think that this is the biggest question that we are trying to answer when we're dealing with clients. The question is, am I going to be okay? And if you plan ahead, you plan early, you get advice, regardless of what your position is, you're going to improve it if you do put some planning in place. So I think that's probably the key message from this with everything that we've spoken about.
Yeah, absolutely. Really ties a nice bow around it.
Probably the last thing that I've got as well, just on this, is if you are in a position where you're asset rich and cash poor, I mean, okay, maybe you haven't planned ahead, because I don't want to discourage people that are in that position that maybe they don't feel like they've got that amount of time. But if you are asset rich and you're cash poor, you do still have choices. If you've got the assets behind you, there are things that you can do. And even talking about some of those things that make people uncomfortable or they necessarily don't understand, if you work with someone, a trusted professional, a financial planner, you should get the level of comfort and at least know what options that you've got available to be able to change things up a little bit to try and improve your income so you can live a better lifestyle with a greater degree of income. Sort of throw back to a couple of episodes, because this seems to be a really hot topic at the moment with investment markets being volatile. We did speak a lot about capital guaranteed products. So there is an option out there to be able to really manage the risk associated with investing that could be quite relevant for people that are financially nervous around it, haven't had a lot of exposure to it, or are investing large amounts of money in order to do it. But yeah, you do have options if you are asset rich and cash poor. It's not something that you're in this position and you're stuck with it and you have to live off whatever income that you've got. You do have choices. So yeah, ties back to the first one. Go and talk to someone, put a plan in place, and move forward with it.
Brilliant. Love it. Love it. Great summary. Great way to end it. And so I'm not even going to try and tie a bow around a bow that's already there. So thanks again for another podcast, Billy. Thanks for jumping on to the last podcast before I'm off for about a month or so. So always a good way to end it, and look forward to catching you all on the next one. Might be a little bit rusty and sleep deprived.
It's like riding a bike, Andrew. I'm sure you'll be fine. But to our listeners, thank you once again. If you need anything, contact details are in the show notes, and we look forward to catching you on the next one. Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.